Here we want to bring in Peter Andersen, Chief Investment Officer at Andersen Capital Management. Peter, welcome. Good to have you with us. Okay, you heard what Bob just said. Stocks good, consumer good, economy, fewer recession worries today than there were 6 months or a year ago. Inflation coming down. Looks like last innings of the rate hike regime here. So why is Peter Andersen raising cash to the highest level in a decade or so?
Well, first off, I agree with all the points you mentioned, so I remain an optimist. So this is going to sound a little bit contradictory, but I do think we have to get a little bit sober that only 4 of the 11 rate hikes are a year old, Tyler. So that's about 2.25% rate hikes that we're seeing impacting the economy. We still have 3% to play to work itself through. So I'm a little bit hesitant to see if the Fed has done such a great job that this soft landing will actually happen. I do put a high probability on it, but I'm just a little bit cautious as we go into the second half of the year.
But you've been in the no recession camp for a long time. You're not changing your tune here, are you?
Not at all. The main reason is, and thank you for crediting that to me, because I have been in the no recession camp for over a year on this program. And I'm glad I've been in that position because as we see, I think that's actually going to happen. However, artificial intelligence, names like NVIDIA, which has been my top holding, it got to be almost 20% of the portfolio. So I don't like to take that much risk on that kind of one single name. So I've halved that position just because it is so dominant right now in the world of artificial intelligence. And if the company makes any little mistake, there is a vulnerability there. So the main reason is I love artificial intelligence. I think I'm very optimistic about it, but let's take a little speed off the ball and say it's not going to be the cure-all for the rest of society.
I want to sneak in one more question before I bring Kelly into the conversation here. I take your point that maybe only 2.5% of the interest rate hikes are 12 months old, have reached the yearling stage or older, and that interest rate hikes do affect the economy at some lag. But a lot of the effects of interest rate hikes are pretty doggone immediate. Mortgage rates go up when rates go up. Credit lines go up when rates go up. Auto loans go up immediately when rates go up. And so the effects on those fronts are not at a lag. They're pretty doggone immediate, aren't they?
They are. But I think on a secondary level, on a more subtle level, you start to see things like Yellow, the truck company, banks fail. There is a lag in like the secondary effects. And I think that's what we worry about has everything been demonstrated to respond to these rate hikes? And history will show you that it does usually take about a year to be fully complete. And remember, we're not even halfway through in terms of the amount of percentages. There's still 3% of hikes
that need to hit that year point, that year.
Yes, that are less than a year old. So I'm hoping the Fed is looking at this. I think what everybody's thinking is, okay, we're almost there. We still have more rate hikes to season, so to speak. So we're hoping that the Fed is seeing it that way too, and that maybe this last meeting they had was the last of the hikes.